Welcome to our discussion on debt. Insert evil laughter here. Basically, we're going to look at the different formulas and things that are used to compute loan payments, whether it's credit cards, mortgages, or whatever. This is money you owe other people, and obviously you want to try and keep this to a minimum. Okay, just like before, we've got some basics. Principal is still like it always is. It's the amount of money that you start with. When it's a savings plan, it's the amount that you originally invest. When it's a loan, it's the amount of money you originally borrow. An installment loan, or what's called an amortized loan, is a loan that is paid off with regular equal payments. It's pretty much what all loans are, and they normally just call them a loan instead of an installment loan. The loan term is just the time you have to pay back the loan in full. 5 years, 30 years, 15 years, depending on what kind of loan it is. Here is the loan payment formula. You will notice it is very similar to the savings plan formula, and you're probably wondering, oh gosh, how am I going to keep those two formulas straight? Well, I can tell you the big difference is loans are bad, right? You owe money. And so that's the one with the negative exponent because it's a bad thing. That's how I always remembered it as a student. The positive exponent one is the good one because that's where you're saving money, that's your money. And then the negative exponent one, that's the bad one where you owe money. And then, of course, all the letters mean the same thing they always do. The payment is your regular payment, usually monthly. P is your starting principal, APR is your percentage rate, N is the number of payments you're making per year, and Y is the overall term of the loan, again, in years. Okay, principal and interest. The portions of your loan payments that you're making, some go towards principal and some go towards interest. In the beginning, more of the money goes towards interest and less of it goes towards principal. And then as the terms proceed, more and more of those loan payments are going towards principal and less of it's going towards interest because you're basically paying down the principal. So you're being charged less and less interest as it goes on, which means that anytime you can make payments more frequently, you're better off. Just like I talked about in the video about savings plans, if you can put that money into your saving plan more frequently. So if you can only afford $100 a month, instead of putting $100 a month into your savings plan, if you can do $25 every week, which is pretty much the same thing as $100 a month, you will actually earn a lot more money in the long run because you're putting it in more frequently, so you're getting more interest on those earlier amounts of money. Plus, also, the other thing is there are more than 4 weeks in a month, so you actually end up making more payments than you would otherwise, right? Because there's 52 weeks, and if you do 12 months times 4, that's 48. So you actually end up making an extra 4 payments every year into your savings. The same goes for paying off a loan, right? If you owe money and you can only afford to pay $100 a month to pay down your loan, if you actually make your payments as $25 per week instead of $100 per month, you're putting that money in earlier, which means the principal is reduced earlier, which means the amount of interest on that, time period is less. And so you'll actually end up paying off your loan faster. This is very common with mortgages. You get a 30-year mortgage. Instead of paying your mortgage every month, you'll do what are called bi-monthly payments, which is every 2 weeks. And again, the idea is you take how much you would pay in the month and you just cut it in half. And most people, if they do that, it doesn't mess with their budget. But what most people also don't realize is that if you pay every 2 weeks, remember there are 52 weeks in a year. So if you pay every 2 weeks, you're making 26 payments. Whereas if you paid just twice per month, right, you would make 24 payments. You're making 2 extra payments. Again, you're doing one whole extra month's worth of payments. So you don't really feel it in your pocketbook, so to speak, but that extra month that you're paying during the year is going straight to principal. And because of that, you end up paying down the principal a lot faster. And a 30-year loan, if I remember correctly, and this is just off the top of my head, so I could be wrong, but I thought it was something like if you did bi-monthly payments, a 30-year loan was paid off in like 17 years. It cut it almost in half, which is pretty amazing, which means over the life of that loan, you're paying a lot less interest. Okay, so early and often, right? Take these payments, whether you're paying into a savings or onto a loan, try and pay them as frequently as possible. And most places will let you pay more frequently, right? It won't be like you have to pay monthly and nothing else. You can pay it uh, sooner. Okay, so here's an example. Student loans, right? $7,500, APR of 9, 10-year loan time. What's your monthly payment? How much are you going to pay over the lifetime of the loan? And then what is the total interest you're going to pay on the loan? All right, so let's use our formula, put in our numbers, do the math very simply. We get that our monthly payments are going to be $95 and 1 penny. Over the 10-year term, your payments will be that $95 and 1 penny per month times 12 months times 10 years, right? Or basically 120 of those payments. You multiply that out and you end up paying back $11,401.20. Well, you remember that the loan was originally only $7,500. So when you subtract that $7,500 from that 11,400 and change, you'll see that you ended up paying $3,901 roughly in interest. That's how much money the bank or whoever is earning off of you just on interest alone. Now, that's only a 10-year loan. 30-year mortgages on your home systematically end up costing more than twice the amount. So if you borrow $100,000 to buy a house and you finance it for 30 years, at the end of that 30 years, if you just paid it off normally and you didn't pay it off early and didn't do the bi-monthly thing, you just made your monthly payments like a good little robot. At the end of that 30 years, on a $100,000 loan, you will have paid back well over $200,000, which means you have doubled the price of that loan, doubled the price of that house. So just keep that in mind that interest accumulates rather quickly on longer loans. Here's an example of what's happening in those first 3 months as far as what's the money doing? How much of your payment is going towards principal and how much is going towards interest? And you can see that because in the beginning, most of it's going towards interest, you're not really paying anything off in those first few months. And in fact, it takes a while to pay things off. We're going to see a graph here a little bit later that you'll see visually how that works. Okay, credit cards differ only a little bit in that you're not required to pay off your balance, which is a bad thing for a lot of people. And interest is deferred for a certain amount of time. So if you do pay it off, you don't actually end up paying interest. But if you don't pay it off, they back charge all that interest, which a lot of people don't realize. They think, oh, I've got 30 days to pay it off. And then if I don't pay it off, then they start charging me interest. No, no, no. They start charging you interest on day one. If at the end of 30 days you have paid off your credit card, they basically waive that interest. But if you don't, they basically just slap that interest on and then continue to charge you interest on top of that, which is how people get into very large credit card debt very quickly. So here's an example. Let's say you have a credit card balance of $2,300, an annual interest rate of 21%, which is pretty par for the course for credit cards. You decide to pay off your balance over 1 year. How much will you need to pay each month? Assume you will make no further credit card purchases, so your balance won't go up. So you put in your principal of 2,300, you put in your APR, you do all that stuff. You need to pay $214 and a little bit each month for 1 year. Well, if you do the math, you'll see that that's a lot more, right, than $2,300. So you're much better off if you can to pay more of it off in the beginning, and then you end up paying less interest in the end. Mortgages, same thing, right? We know what a mortgage is. Down payment, we know. Closing costs are just fees you have to pay to get the house at the end, and it's lenders' fees and escrow fees and all sorts of BS that they just charge you. And unfortunately, there's just no way around it. Sometimes they have fees that are charged as points. They'll talk about, you get an interest rate with 1 point, and 1 point means you're paying 1% of the loan value in fees up front as an origination fee or a discount point, and that 1% is just being rolled into how much you owe. Now, if you're going to be in your house for a really long time, it might be a good idea because paying that money up front will maybe discount your interest rate. So instead of paying, let's say 5% on your loan, you pay this fee up front, and now you're only paying 4% interest on your loan, which over the lifetime of your loan could absolutely save you a lot more money than that 1% you paid up front. But if you're only going to be in your house for, 3 to 5 years before you decide to sell it and move or refinance, it's a losing wager to pay that 1% up front. And again, a lot of people don't know that. They don't know how to do the math. And these mortgage lenders will talk them into paying all these upfront amounts to get the interest rate down. And all that does is just add a lot of extra money to the principal of your loan, which then in the beginning adds a lot of interest. And then they end up making a lot more money. You end up paying down your loan very little, and when you go to sell your house 5 years later, you find out that you've made all these payments and you still owe pretty much the same amount, and you have no money. Okay, fixed rate mortgage is one where your interest rate is fixed over the entire life of the loan, whether you get a 15-year, 20-year, or 30-year. They're actually now offering 10-year mortgages, but it has to be a very small amount. You have to have really good credit. An adjustable rate mortgage is one where it will readjust based on the prevailing rates of the time. So it'll maybe be steady for the first 5 years, and then it'll adjust every year after that or every 5 years after that. They're called ARMs, for adjustable rate mortgages. They're risky because rates could go down, but rates could also go up drastically. Here's an example. You can either get $100,000 at 30-year fixed for 5% with a closing cost of $500 plus 1 point, or you can get 4 3/4 on a 30-year loan, but their closing costs of $1,000 plus 2 points, and they want you to evaluate the two options. So the first thing we're going to do is figure out how much our monthly payment would be for just 5% interest. Right? So the first bank, if we just paid 5% for 30 years, our monthly payment would be $536.82. Now, in addition to that, if we did the 4.75, it would be 521, right? So 536, 521, not a big, huge difference. But then you got to start looking at your points, right? So you save about $15 per month with the lower interest rate. But now we got to think about closing costs. So that's that extra 500 because it went from 500 to 1,000. You also got to think about the upfront money. The one bank charged 1%, and 1% of $100,000 is 1,000. The other one charged 2 points, right? So $2,000. So that's an extra $1,000. If we take all that extra stuff, the extra 500 in closing costs, the extra $1,000, right, and the difference between 1 point and 2 point gives us 1,500. If we divide this over the life of the term, the life of the loan, we could see kind of how much our monthly payments really are. Or in the other case, which kind of makes more sense for most people because a lot of people don't know how long they're going to be in their house, and they know, oh, I'm only going to be here 5 years, I'm going to be here 10 years, is you can instead just figure out, okay, that extra $15 a month, that, the difference between the two prices, the two monthlies, remember that it was, one was 536.82, right, and one was 521, so basically that extra $15. Well, we also had an extra 1,500 for the other more expensive one, or the cheaper one. So the difference between those two, you divide 1,500 by $15 a month, and it would take 100 months for the cheaper one to catch up with the more expensive one, or vice versa. Right? That's kind of your break-even point. Well, 100 months is about 8.5 years. So that means it's going to take you that much time for it to make up for it. So unless you're sure that you're going to be staying in your house for more than 8 years, it would be better to go with Big Bank and pay a little extra per month and not have to pay all those extra upfront costs. But if you're going to be there in the long run, right, you're going to be there for more than 8 years, then those extra upfront costs get spread out over a longer time, and they end up not costing more than that $15 you're saving. You're saving $15 a month, and after a certain amount of time, that pays for that extra 1,500, and then it keeps paying, right? So you actually end up keep saving money. Okay, here's what I was talking about with the interest and principal. As you pay down a loan, the amount of money that goes towards interest gets smaller and the amount of money that goes towards the principal gets larger. And this is kind of the relationship between the two. The blue represents interest, the kind of pink represents principal. And basically, if you take any point in time and draw a vertical line, the vertical distance in pink is how much money is going towards principal, and the vertical distance in blue is how much is going towards interest. And you can see in the beginning, there's a lot going to interest and very little going to principal. And then it starts to grow quickly because as you put more and more money into the principal, you're getting less and less interest, which means that that monthly payment is putting more towards principal. So that's why paying things off earlier, right? Taking your payments and breaking them up into small pieces and paying more frequently gets that curve growing faster. Okay, here's another example. You have your 30-year fixed loan at 4%, an adjustable rate with the first year at 3%. Suppose that the rate rises to 5% on the third year. How will your payments be affected? Well, on a $100,000 loan, you're basically paying $4,000, 4%. With the 3% arm, you're basically paying $3,000. So it'll save you $1,000 in interest during the first year, which means a monthly savings of about $83. However, by the third year, when rates reach 5%, the situation is reversed, and now you're losing $83 per month, whereas you would have been saving $83 per month if you stayed with the 4% loan. So the bottom line is, right, it's not rocket science. You only do an ARM if you know you're going to be in the home for a short amount of time, or you know you're going to, what's called, gosh, now I'm blanking on it, refinance. Because if you just go for the arm and you let the dice roll, you don't know if the prime interest rate is going to go up or go down. And if it goes up, and especially if it goes up by a lot, your payments all of a sudden are going to go up by a lot and you're going to be in big trouble.